Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking clean energy stocks and my guest is Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. Greenhouse gas emissions from the power sector are expected to fall for the first time this year, according to a report from a London think tank, as growth in renewables such as solar and wind outstrip demand for electricity. It's one potential tipping point that, from the point of view of the investor, would appear to make renewable stocks a no-brainer. Why then, after a massive run-up in 2020 and another burst after last year's US Inflation Reduction Act, have clean energy stocks largely disappointed? Supply chain issues and trade tensions, notably with China, which dominates supply of materials for EV battery production, are two factors. Detractors also label targets on net zero emissions and decarbonisation as unrealistic and expensive, and say IRA incentives can blur the ability to examine an already complex sector. But the IRA represents around $370 billion of investment in US clean energy projects, and though the Ukraine war has pushed demand back to traditional energy sources, the long-term drive to clean energy appears unstoppable. So have investors had unrealistic expectations? Well, joining me now to discuss that is Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. Bob, welcome to Sectors Up Close. Thank you for joining us. The first question is why? Why has there been a less than stellar performance of renewable stocks since that huge run-up in 2020?
First of all, let's look at that huge run-up in 2020, right? I mean, it happened during a period, of course, we're right in the kind of pandemic. A lot of folks were thinking that traditional fossil fuel industries were going to be stagnant for some time. And just in general, there was a rush towards ESG assets in general. During that period, I think it was really a reflection, self-reflection that people had while they're sitting at home and thinking about, the world around them right at that point in time. So the run-up was really not necessarily based, I wouldn't say, on ROI expectations as much as it was kind of this collective hubris. But then we came into, as you mentioned already, David, kind of the 2021 period. People are starting to come out of the homes. Fossil fuels began to pick back up again. And certainly as we moved into 2022 with the war, that was a major impact, of course.
Well, that Inflation Reduction Act for investors, has that been a disappointment given the challenges it can present?
There's kind of this general transition phase as people figure it out and figure out how to work into it. So I don't think it's necessarily been a disappointment. And the nice thing is it's there, it's been passed, the spending is in place, and any of these projects are going to still be kind of run into the headwinds that we just talked about, particularly around infrastructure build out and so forth. So we're still looking at supply chain issues for a good 2 to 3 more years. And that's probably going to be, again, a little bit of a headwind for now, but what you see is a lot of projects gearing up in the right spaces too.
It is, of course, also a very diverse space. The iShares Global Clean Energy ETF has Chinese companies, US companies, utilities, solar, and many others. Are investors better to possibly pick individual stocks rather than follow funds?
A lot of these companies are smaller or they're offshoots of larger existing, say, utilities at the end of the day, but their business models are still new and unfamiliar. We still have, again, all these very complicated supply chain issues. We have a lot of dominance, of course, from China, both in terms of the factors of production as well as the rare earth minerals that are utilized in the very important part of storage and batteries. So all those things make it a difficult kind of calculus. And then you throw in the IRA, right? So I think for now, it's very difficult to not be a professional, to not rely on somebody who knows what they're doing in this space. I for one, would definitely go with the diversification and the expertise that are inherent in ETF and fund products.
Let's look at a few specifics. In your notes to us, you mentioned clean hydrogen has a big future, and in terms of companies you like, Enphase. Why do you like those, and what other things are you looking at in this space?
The shiniest tool, if you will, in the renewable toolkit is, of course, clean hydrogen. For a lot of reasons, we've had gray hydrogen out for some time, but a lot of the emissions that come out of that process and the use of that product aren't exactly favorable. What they're doing now, and the IRA is funding quite a bit of this, is actually trying to understand how can we build out more of an infrastructure around clean hydrogen? How can we locate the hydrogen hubs, as they call them, nearer to where they're needed, such as grids and utilities? And in terms of companies, as you mentioned, yes, I think the good place to look is what are the companies that are building out the infrastructure to allow the use of renewable energy to scale? And so certainly infrastructure around generating renewables is a strong area to look at. But I like Enphase because it's actually facilitating the usage in the retail environment, in the small business environment, if you think of the footprint there, it's huge. And in general, from a business model perspective, margins tend to be wider and more generous in retail spaces as opposed to industrial. So I think for a lot of reasons, that's a company to look at for the next several years.
Bob, those are some great insights into what is a fascinating sector. Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. Thank you for being with us on Sectors Up Close. And that is your roundup of the clean energy sector. I'm David Pollard, and this is Reuters.